So we're going to get started. Good afternoon, everybody. I am Sean Law. I work here at TD Ameritrade. I'm alone, sort of alone. I have Marcus here with me today. But Ben's out at SciPy, so he's having a lot of fun out there. So a lot of the typical preamble, as always, for this PyData meetup to occur, we'd like to acknowledge NumFocus, as well as TD Ameritrade, and Spark and Midas, especially, again, Midas for supplying the food and sponsoring the food. And for those who are new, a couple of important points. Emergency exits in case of anything that happens. There is an exit right up here, and an exit right out the front doors that you came in through. We're always soliciting for speakers, so we would love to get local speakers to, if you work at a company, work at the university, come tell us your data stories and even some of your data failures. Because we all know that we aren't all experts in creating success, right? And it's important that as a community, we kind of own up to those failures too and share those stories. Marcus is in charge of workshops that we're planning up in the upcoming months. So please reach out to Marcus standing over there in the hat. If you have ideas of hands-on workshops that you might want in the future. And also, as always, we're always soliciting feedback, things that we're doing well, and more importantly, things that we can improve upon. That would be great. Always visit us, our GitHub page at PyData and Arbor. You can always find the talks there, as well as other information. And also, you can tweet us or send us an email, pydataaNarbor@gmail.com. And also, unless you have quick questions during the talk, please hold your questions to the end. And remember that we're in a borrowed TD Ameritrade space, so please clean up after yourselves, especially if you've got food and plates and whatnot. Consistent with our previous talks, I'd like to read our PyData Code of Conduct for people that are new. So PyData is dedicated to providing a harassment-free meeting experience for everyone, regardless of gender, sexual orientation, gender identity and expression, disability, physical appearance, body size, race, or religion. We do not tolerate harassment of meeting participants in any form. All communication should be appropriate for a professional audience, including people of many different backgrounds. Sexual language and imagery is not appropriate for any of our meetup events. Be kind to others. Do not insult or put down other attendees. Behave professionally. And remember that harassment and sexist, racist, or exclusionary jokes are not appropriate for PyData. Attendees violating these rules may be asked to leave the meetup at the sole discretion of the meetup organizers. And thank you for helping to make this a welcoming and friendly event for everybody. Okay? And with that, I always like to, as you know, do an icebreaker, just so that when you leave here, you would have at least met somebody. So today's icebreaker is turn to somebody either to your left or to your right, and either tell them a data science or data-related conference that you've been to, or a conference that you would like to go to in the near future. Introduce yourselves. Make a friend. Real quick.
Hey, I'm Gus.
Hi, do you want my hands over there?
Yeah,
Yeah, my name is Oliver. Nice to meet you.
Nice to meet you too. I'm the speaker.
You're the speaker? Wow. Oh my gosh. I thought I looked at the picture of the speaker. I must not look close. You look like an old guy. And you're definitely not an old guy.
Yeah, I don't know.
Maybe I just probably skipped something.
Yeah, so what was the question? Yeah, I'm from Boston. I work at Quantopian. Have you heard of it?
Yeah, we don't know a lot about it.
Yeah, we're a platform based in like develop stock trading strategies. And
Hey, and we're back. Hopefully.
no, I got here for a few days. Yeah.
Thank you. So, this is good. This is good. I asked for this myself. Thank you. So, as always, we like to talk quickly about sort of a maybe an interesting thing in data science this month. Actually, this has been around. So, I came across something called PyCheck.io. So if you're somebody who is looking to improve your Python skills, you can go there and you will be presented with problems, Python-based problems, or even, I guess, they support JavaScript as well. So if you're kind of trying to improve your skills, check that out. Or even if you're an interviewer, you're looking for good, solid questions to ask, skills questions. That's also a great place too.
Can I interject?
Yeah.
I think I'm one of the people that introduced this to you. There's two sides of this website. Not only does it do the JavaScript and Python side of things, and it's like practical interview questions that you might, like a whiteboard question, like return all the redundant elements out of a list, that sort of stuff. Those kind of questions, but they increase in complexity. But furthermore, they have another side. It's called it's like War of Empires or something like that. And it's actually, think of like Clash of Clans, but you can actually click on the turrets and optimize them with Python code or JavaScript code. And it's just a fun way to implement your code in a different way.
And one other thing, we've been doing this for a few months now. So the folks at O'Reilly have been kind enough to offer free ebooks. So if you tweet at us at PyData and Arbor, you can grab one of these free ebooks. And then last but not least is advertising for next month's PyData Meetup. So we have Sebastian Rashka, who's a graduate student who is graduating soon at MSU, but he was also a great author that wrote the book called Python Machine Learning. And next month he's going to come in and talk about an introduction to deep learning with TensorFlow. So definitely come out and catch that one. Sebastian arguably is one of the greatest educators of machine learning in our generation. Now, this is my opinion, maybe because I went to MSU. But it'll be on Thursday, August 24th. And Sebastian is just generally a great person to have around. So with that, I'm going to let you plug in.
Oh, sure.
And I'll introduce our speaker today. This is Gus Gordon from Quantopian. So Gus is a data engineer at Quantopian, which he'll tell you a little bit more about. But he did his undergrad in physics and economics at Bucknell University. And he was mentioning that I think his COO was a Michigan grad. Is that who it was?
Yeah, exactly.
Yep.
Yeah.
And let's welcome Gus. Thank you.
Yeah. Thanks a lot, Sean. It's great to be here. It's really nice out here. So thanks everyone for coming. So today I'm going to be talking about how to develop a stock trading algorithm using only open source Python tools. So just quick disclaimer I have to show. I'm sorry. Okay. Read it. Okay. I think that's good enough. So if you want to develop your own algorithmic stock trading strategy, you have like three main ways, I think. So the first way is to use a platform like Quantopian. So this is definitely the easiest and fastest way. So just a quick shout out to my company. It's basically a website where you can go on and develop your own trading algorithm. So right now we support US stocks and futures. And if your strategy is good enough, we'll find you and contact you and maybe invest some real money in that strategy and give you a share of the profits. So that's probably the easiest and fastest way. But there are certain limitations of that. For example, you're using someone else's platform. You have less flexibility inherently when you do that. So another way is to build your own tools, like your own way to test your trading strategies, and that's called backtesting. This is not great because it's really time consuming to actually build tools that are very good and usable. There's a million different things. There's many different edge cases that you run into if you build your own tools, although it is doable and people do it. The last main way is to use pre-existing open source tools. So at Quantopian, we've open sourced a lot of our core product. We have our backtester, which allows you to test your stock trading strategies. And then we have different analyses packages. And this is what I'll be talking about today. So how to use open source tools, in this case, Quantopian's open source tools, to build your own trading strategy. You can just do this on your computer. You're not dependent on another platform or anything like that. Right. So the first thing when developing a trading strategy is to have some sort of hypothesis or idea. So like, for example, that idea could be like, I think a stock's price is going to go up when a lot of people tweet about it, or I think stocks exhibit mean reversion, meaning the price will always return, or not always, but will often return to like a previous value or something like that. So yeah, you start with an investment hypothesis. So I was trying to think about what, let's see. I was trying to think about what like a good idea for this talk would be. I guess it's a little small, but the talk on the left here is called Rainmakers, Why Bad Weather Means Good Productivity. And so this paper basically says that when it's rainy outside, people are more productive working inside. And specifically, they're more productive at like menial tasks, like data entry, stuff like that. And when it's sunny outside, they're like more creative. And then another paper sort of in the same vein, but this time involving the stock market, is called Good Day Sunshine, Stock Returns and the Weather. And it basically concludes that like when it's sunny, stock traders are sort of see more like glass half full. They predict that stocks will go up. So that means that stocks will go up. So basically, like if it's sunny on Wall Street, the market will tend to have a good day. So I took these two papers. So the algorithm we're building today will take rainfall at a given company's headquarters as a signal. So like, for example, Apple is in Cupertino. So we'll take if it rained in Cupertino as our signal for determining whether the stock price will go up or down. So then more formally, our hypothesis is that recent rainfall at a company's headquarters has an effect on that company's stock price. Okay. So in order to actually do this, we need a few things. So first, we need to gather all the data. So what we need is company tickers, we need rainfall data, and pricing data. So this will be kind of like the first half of the presentation. And then once we do that, we can investigate this rainfall signal with alphalens, which is, so all these are Quantopian open source packages. So we'll investigate it with alphalens, then we'll create an algorithm with zipline, and then we'll analyze the resulting backtest with pyfolio. Okay, so the first thing is gathering required data. So we need a universe of stocks to look at. So we need like a set of ticker symbols, right? So a good set of ticker symbols to start off with is the S&P 500, which is just 500 U.S. equities. So it's actually really tricky to get the historical S&P 500. It's trickier than I thought it would be. Like the S&P 500 website only has the current S&P 500, so you have to like look in other places for the historical one. So I found this repo on GitHub that has like that automatically updates its list of the S&P 500. So I just kind of like pull in these CSVs that are historical, and then I can read in the S&P 500 for that year. And I'm just using yearly S&P 500, but you could use like quarterly or whatever too if you wanted a higher resolution. And we're using the S&P 500 at the start of the year to avoid survivorship bias. So if we just said the S&P 500 for 2015 was the S&P 500 at the end of 2015, then we would tend to pick stocks that survived 2015. And we're still in the S&P 500 throughout 2015. So that's called survivorship bias.
Quick question. Are you using the index or the 500 tickers making up the S&P?
The 500 tickers in this case, yeah. Because we just want like a list of 500 names that our strategy will use. It's just nice to have like a finite list. Okay, so now we have the S&P 500. So for each company in the S&P 500 for our strategy, we need the address of the company's headquarters. And then once we have the address, we can get the rainfall. at that address. So this is like another tricky thing. So there's this like little function here. I won't go too deep into it, but basically it tries to get the company location from the Securities and Exchange Commission. You can basically just like enter a ticker symbol into their website and it will give you the address. And if that fails, then we try to grab it from Bloomberg. And so this function just returns like an address, or maybe a zip code in this case. Yeah, I think it just returns a zip code. So now that we have this zip code, that just gets plugged into GeoPy, which is a really nice package I found. I don't know if any of you have heard of it, but you can just like give it an address and it will look up the address for you and give you a set of geographic coordinates like latitude and longitude. And it's really nice. So then basically we go through each of the 500 symbols for each year. And we store a mapping from our symbol to latitude and longitude. And we just store it in a pandas data frame here. And you can see it right here. So our index is the symbol on the left and the latitude and longitude on the right. So just glancing at this, it seems correct because the latitude is positive and the longitude is negative, which kind of means we're like in the northwest like quadrant of the world, which is where the United States is. So it makes sense that U.S. SOX would have headquarters with those latitude and longitudes, if that makes sense. Okay. So now that we have the company locations, we also need U.S. weather stations. So weather data is something else that's tricky to find, but the NOAA, National Oceanic and Atmospheric Administration, has this data on their website in a pretty decent format. So they have a bunch of weather stations around the world, around the U.S. And they also store their latitude and longitude. So there's like 3,000 stations or something around the U.S. So this weather stations data frame here is just a list of weather stations and their latitudes and longitudes. So now we have company locations and weather station locations. And this is a map of so the blue dots are weather stations and the red X's are S&P 500 headquarters. So you can see the weather stations are kind of scattered around the U.S. and so are the headquarters. So now for each of these headquarters, we want to find basically like the closest weather station with data. So then we can map the headquarters to a weather station and get the data from that station. Okay. Right. So this function just maps our headquarters to the weather station and then gets the weather at that station. So this is a little tricky here. So this presentation will be online afterwards if you want to dive into the code more. But just skimming through it, we just get the latitude and longitude for the company locations, find the closest station, and then this function here that I'm not showing, get station precipitation, gets the rainfall data from that closest weather station, and then stores everything in a data frame. And if the weather station, for whatever reason, has a bunch of like missing values, then we just go to like the next closest station, if that makes sense. Yep. So then all that gets stored in a data frame called symbol HQ precipitation.
Are those daily figures or?
Yeah. So there are daily figures, right?
Would it have to be? Is it a forecast or is it a past?
It's past real data, like actual rainfall data. So, like for example, whatever the AAP ticker symbol is, it rained there on January 2nd. And the units here are tenths of millimeters of rain. So you can see like at Apple, AAPL, it didn't rain at all. But like some other symbols, it did rain a little bit. This is just like the first 5 rows of that data frame. Okay, so now we have all the rainfall data we need. So the last thing we need is pricing data. Pricing data is pretty easy to get. So Yahoo and Google both provide daily pricing data. So they both provide like, okay, what is the close of Google? Sorry, let me think of a better example. So like, what is the close of Apple on like any given day? And they just have daily data. So this function just goes through our S&P 500 symbols, and it grabs the closes. It tries to grab the closes from Yahoo, and if that fails, then it gets it from Google. And then that all gets stored in a data frame called pricing. Zoom out here. So here's the pricing data frame. So you can see it just stock prices daily for every symbol here, where the columns are just the ticker symbol. And so this is all of our pricing data. So this is pricing data from when we started getting the S&P 500, which was 2015, to present. So it's like 2.5 years of data. But one thing I would recommend is to create like a testing set for pricing. So to like withhold some data so that you have some data that you haven't looked at that you can use later in the process to see how your algorithm would do after you've actually made the algorithm on data it hasn't seen yet. So this is a simple way to just like withhold data. So right here, I just make another data frame called pricing_test, which is just this, except we're not including 2017. So this is like 7 months of data or so.
Does Google adjust for splits and dividends in data?
I think, yeah. So Yahoo does, but Google, I think, just adjusts for splits, not dividends, if I'm correct. Yeah, okay. Yeah, so Yahoo is a little bit better, in my experience. Okay. So now that we have like all the data we need, we can generate our trading signal. So for our trading signal, I thought that like using a 3-month rolling mean of daily rainfall would be good, because like earnings get released quarterly, which is like every 3 months. So maybe that makes sense. Obviously, like you could experiment with this. So I'm just taking the rolling 3-month mean of the rainfall at each headquarters, and then then normalize that rainfall for each headquarters so that our maximum value of rainfall is like 1.0, and then our minimum is 0. So then every value here should be between 0 and 1, besides things that are missing. Right, so you can see like some stocks have more rainfall, some have less.
What's the not a number?
That just means there's missing data. So like maybe the pricing data, or sorry, maybe the weather station like didn't have precipitation data on that in that period or something.
Is it only rainfall, or is it precipitation, so it includes snow?
I think this is just rainfall though, but that's a good point. I should be more clear. Okay, so now I'm going to break out of this. So this is all in a Jupyter notebook, by the way, which is like a really convenient way to do things, because you can kind of just do everything that you need to develop the strategy in this. Like I'm just doing it all in one notebook. Makes it easy. So now that we have our signal, the S&P 500 rolling 3-month like daily rainfall, then we can start to use alphalens to actually analyze how that signal does. So here I'm putting this signal through alphalens. So there's this function here. Let me highlight it, which just like formats our data. And then once it's formatted, we pass this factor data variable into create summary tear sheet. And this will make an alphalens tear sheet, which allows us to look at our signal and how, in like what our signal, in like how our signal is correlated to prices or vice versa. So what alphalens does is separates our data into quantiles. So you can see the 10th quantile here is like where it has rained the most. So you can see the mean is 0.95. So the 10th quantile is stocks where it has rained a lot. And as you go up, like the first quantile is stocks where it hasn't rained a lot, day by day. And then you can see other things too about that. And this is just like a summary tear sheet. But alphalens has like other things too. This is just a sort of a succinct version of the full tear sheet. And then, actually, I'm going to skip to the end for a second. So here are 10 quantiles again. And this is our mean stock returns for each quantile. So you can see in the first quantile, where it hasn't rained a lot, our mean return is very high. And in the 10th quantile, where it has rained a lot, our returns are like negative. So that seems to suggest that companies where it has rained a lot, companies' headquarters where it has rained a lot, will tend to underperform. And going back up, so yeah, you can see like our mean returns are all negative. So basically this means like if we invested with the higher values in our signal, like if we went long on the higher values in our signal and short on the lower values, we'd lose money. So maybe we probably want to reverse our signal. And also this is just using our test pricing data. I should have mentioned that. Because we don't want to expose ourselves to the data we've withheld. And then this is our turnover, which is basically saying like how much does your signal change day by day. Okay. So from alphalens, it seems that our signal should be that stocks where it rains a lot at their headquarters we should short, and stocks where it hasn't rained we should go long. Okay, so now moving on to actually like building a trading strategy with this information. So if any of you have used Quantopian before, this is like very similar to that. So this is using zipline, which is what we use at Quantopian. This is our backtester basically, and it's pretty easy to run on your own. So this initialize function here, this just like sort of sets up variables for us. So you can see this short threshold here means that any stocks where the rainfall signal is above 0.85, where it has rained a lot, will go short. And then the long threshold is any stocks where it hasn't rained a lot, where the signal is less than 0.15, then we'll go long. And there's some other stuff I'm setting up here, like just set the gross leverage to 1. So we invest around 100% of our money. I'm just using 0 transaction cost, so no slippage and commission. So this just allows us to get like a good first look at the signal without having to worry about this stuff like muddying the waters. And then this basically, the schedule function thing just means I'm going to run this trade function, which is defined down here, once at the start of every week. So then this trade function basically just grabs the rainfall for the current day. So I can get the current day in the backtester by using this function and get date time that I imported up here, which pulls out the current date that we're like on in the backtester. So this runs through every day, and trade will go once a week. So like this will return like the date of the week start every time you call it. So then every week we grab the 3-month signal of rainfall, with using the data on that day, our signal, and then we iterate through every stock there. And if the signal is above 0.85, then we go short. If it's below 0.15, we go long. And that's all this is doing. So we just set up this variable longs and also shorts. Longs stores the stocks we're going to go long. Shorts is the stocks we're going to go short. And then here's where we iterate through things and just invest such that the total exposure to the market, the total long exposure to the market is 50% of our portfolio, and same with shorts, except on the negative side.
Do you cover your shorts or liquidate your longs when the signal changes?
Yep, exactly. So that's what this thing here is. This closes the previous positions. So anything that has anything where the signal has gone out of that 15% threshold on both sides, where it gets in the middle, then we close out our position. Okay. So that's our trading strategy. You can see it's like not too long. Pretty simple. So then this just runs our strategy.
That was based on the weather event, right?
Mm-hmm.
You don't close the shorts based on the performance of the stock.
Right. No. So we're just closing it if the signal goes outside of that 15% range. But yeah, you could add to this maybe a more developed strategy would put in some stop loss like that. Yeah. Okay, so then to run this algorithm, we just use zipline.run algorithm, and we run start through end here. We just pass in our initialize function, and 1E6 is $1 million. That's starting capital. And then we also pass in the pricing data. And here I'm forward filling it because if there's missing values, then I find it just most simple to forward fill. But you don't have to. Okay, so now we've ran our algorithm. So this the results here get stored in the results variable. And so you could look at this. It's basically like a data frame of results. I'm not showing it here though. I think the best way to look at it is just using pyfolio. So this is the last package in the sort of Quantopian open source suite. So I just pass the results into this convenience function here that will format this for us. So just making sure here that, so actually I should say, I'm even running the full backtest on the data we withheld, just for the sake of this presentation. But if you were actually developing this, you would probably just want to use the test pricing data. But for this presentation, I just wanted to do one backtest run. Didn't want to deal with multiple. So for this first tear sheet, though, we're only looking at the first 2 years' results. So this is just still with our test data, if you will. So we use this function called create full tear sheet with pyfolio. And this just makes a bunch of plots for us. So the first thing that you'll see is all these statistics for the algorithm, like annual return, Sharpe ratio, which is our risk-adjusted return, a bunch of stuff, our beta, which is our correlation to the market. And this is good that it's close to 0. I'll let you learn more about that stuff on your own. So here's our cumulative returns. So you can see, so the gray here is the S&P 500 returns, the SPY, and the green is our strategy. So as we can see, our strategy is up and to the right, so that's great. And that's what we might predict given the sort of the strong signal we saw in alphalens, where we had the consistent returns correlation with rainfall data. So yeah, there's a ton of plots here. We have.
If your portfolio goes net long or short during the time frame here.
Yeah, so there's other plots for that. I'll get to those. Yeah. So there's a ton of stuff here. So just more forms of cumulative returns. Here's our beta. You can see it's still close to 0, which basically just means it's uncorrelated with the market. A rolling Sharp. So Sharp is very noisy. As you can see, like we have a Sharp of 4, and then it goes all the way to 0, like, 8 months later or something. There's Fama French, which are another type of exposure. So we'd like these to be low, but these are fine.
Question.
Yeah.
Do you think that 8 months later that you were just talking about is due to some seasonality?
Yeah, that could be. Yeah, definitely. Like you're saying, like spring to fall, right. Stuff like that. Yeah, I guess that would make sense.
Was there any like ARIMA or stationarity corrections or anything like that?
No, but yeah, that'd be good. Okay, so these are just drawdown periods, which is like how much we've lost from the maximum amount of money we've made. More return stuff. So I'll get to our positions. So this is sort of just a list of our positions.
Is this all auto-generated?
Yep. So you just call that create full tear sheet thing, and it will automatically generate it. Yep. And here's our exposure, which is what you're asking about. So we specified that we wanted to be 50% long, 50% short with 1.0 gross leverage. So we see that that's the case. We're 50% long, which is the green, 50% short, and our net is right on 0, which helps us be uncorrelated with the market. So if I just go down here, so this is our total holdings, so like the number of stocks we've held. So you can see like the most amount we've held is like around 175, but we usually hold like 75 or so, or 80. So yeah, there's probably some seasonality here too, I'm sure. And this is kind of expected. So it's expected that our total holdings goes up and down significantly because we didn't specify. We just wanted like 10 names on the short side, 10 names on the long side. We just said like anything that's above 15% on either side, just take that. And here's our long and short holdings sort of plotted together. So you can see it's like very spiky. Sometimes we only hold like one short position, which is probably not good. So if someone were to like actually, improve this strategy, maybe they would want to put like a minimum of like 5 names on either side or something to reduce your exposure in one name. Our gross leverage we can see is around 1. And it's not perfectly on 1, and that's because we only trade once a week. So if we trade on Monday and then the market changes a lot or our returns change a lot during the week, then we don't adjust for that until the next week. But we're plotting daily. So that's why it's not pinpoint on 1. Daily turnover. So it's spiky here, obviously, because we just trade once a week. But again, we're plotting daily. Daily trading volume. So for whatever reason, we traded a lot at the beginning of 2016 or around there. And yeah, so that was just using our sort of in-sample data, our test data. So now that we've theoretically like developed our strategy, although I've like gone through it quickly, then at the end of this process, then we would use our full data set. And so here I'm just passing the same thing, except I'm using the full results. And I'm also passing a live start date. So this allows us to break, this allows pyfolio to break up our results into like in sample and out of sample. So we can confirm that the out of sample looks good, like given what we've seen in sample. So we want to make sure these things are consistent. So yeah, so we can see that, like from these stats, our out of sample also looks good, which is great. Our volatility is about the same. Our Sharp is actually a little higher, although again, that's very noisy. Our beta is still close to 0. So here's a plot. So we have this. So this green here is exactly what we saw before. The red is what's new. And then we plot this cone of like expectation given our in-sample data. It uses like some Bayesian stuff. Uses like PyMC3. My colleague Thomas Wiki has worked on that. And we can see that like given our cone of expectation, our live results fall within that cone, which indicates that we haven't overfit our algorithm, which is very easy to do. So that's good. So there's some more stuff. But so here I'm not actually plotting the full tear sheet. You can see I'm just plotting like create returns tear sheet, which is sort of just like the first section of that full tear sheet we were looking at before. Okay, yeah, so it looks good. And it's funny because when I like was trying to think of a good example for this talk, like I didn't actually expect this to be good, but I guess it is. Okay, yeah, so this is just the returns tear sheet. So yeah, some possible improvements for this. So as I talked about, we could increase the size and the history of the universe. So we're only using like 2.5 years of data here, but you could go back and do like a 10-year backtest. I think the NOAA has rainfall data from like 1900. So the limiting factor here is going to be like how far back you can get the S&P 500 data, I think, and maybe the pricing data. You could take other weather data into account, like temperature, like snow. You could just tune things like maybe maybe you want to, like as I talked about, maybe you want to put like a minimum of like 5 positions on the short and long sides, so that way you're not like your whole portfolio or half your portfolio isn't in one stock. And also, again, this is like zero slippage and commission. So it's possible that once you apply the effects of slippage and commission, that the returns here go to 0. And this is really just like a fairly rudimentary result. And you would have to like take this and develop it further to actually like consider trading real money on it. Okay, so thanks everyone. So if you're interested in the notebook, that can be found at the link here. Try to zoom in. Here we go.
We'll add it to I'll have you contribute to our GitHub.
Oh, sure. Okay. Yeah, we'll do. Okay, yeah, thanks everyone. And let me know if you have questions.
So if you could speak up, and also if you could kindly repeat the question.
Yeah, sure.
How complicated can the algorithm that you make in zipline get? Like, are there any restrictions? Can I bring in 100 different features and throw in, fancy scikit-learn ensemble and then have zipline backtest that for me, or are there certain restrictions about what it can and cannot backtest?
Yeah, so the question was about how complex an algorithm could get in zipline. So it's really just limited by your computer, I think. I haven't personally run into any problems with it. I assume if you had like a huge server, you could do basically whatever you want. Yeah. Does that answer your question?
I think so.
Okay.
And I think you mentioned earlier in an earlier talk about wanting to add like TensorFlow capabilities.
Yeah, right. So you can use TensorFlow with this actually. It's just on the Quantopian platform, like quantopian.com. We don't have TensorFlow yet. So that's one of the reasons you might want to consider using open source stuff, because you can like it's on your computer, so you can do like whatever you want with it. Yeah.
Weird data nitpicky question.
Okay.
When you showed your initial S&P 500, it had like 517 columns. But then when you showed your Google closing costs, closing prices, it had like 558.
Oh yeah, so that's because so that pricing data has pricing for all the stocks that have ever been in the S&P 500. Yeah, so that I didn't talk about that, but yeah, so we have 3 years of S&P 500 data, so there might be some stocks that are in the S&P 500 1 year, but not in the next year. So that way we have sort of like a union of each year, and then so that's why the pricing data has more than 500 columns. Yeah. Sure.
So let's say like you created an algorithm and you wanted to put it to work. How do people usually actually implement their algorithm in the real world? Like, is there a way that you can
like trade real money,
like Robinhood or like TD Ameritrade to like actually buy and sell?
Yeah, and sorry that I forgot to repeat the question, but yeah, so the question was about like how you can actually trade real money on algorithms. So if you use Quantopian, not to harp on that, but you can do this much more easily. But if you don't want to, that's fine. I think so you can connect things to like interactive brokers pretty easily. I think there's a branch of Zipline that has actually like interactive broker like integration. I think it's called like Zipline Live if you Google it. And then obviously you can just like output the data from Zipline. So you could like, however you want, you could just take that data and like put it into like whatever API you want. Sure.
About that, I know that there's some financial regulations regarding developing some pipeline that does deep learning, some really black box stuff. Big financial institutions can't readily use black box data for trading, can they?
I don't know, actually. I don't want to like say anything that's wrong, so that might be a question for someone else. Yeah.
So considering that it does so well with the rainfall data, have you considered adding things like sunshine, the amount of humidity and so
Yeah,
forth?
I think that would be like the next step if anyone wants to try that out.
Do you think it would be as successful on futures? So considering
I don't
rainfall
know.
is related to like...
Yeah, maybe it would be. Yeah, I have no idea, but maybe that you could definitely like test that pretty easily because Zipline also you can use futures data. You can just put any like pricing data you want into it. So, sure.
Wasn't the initial hypothesis that productivity would be higher during periods of heavy rainfall?
So the initial hypothesis, I'll go back. Yeah, so I just said that it has an effect on the company's stock price because this paper said that returns tend to go up. Like investors are more, they're happier when like it's sunny outside. So maybe like when they visit the headquarters, then they're like more, they're happier about that company, so they think it will go up. And then this paper actually also says that so people are more productive when it rains out, but they're more creative when it's sunny out.
Oh, okay.
Yeah. Yep.
Can you give us an idea of like what the most successful algorithm that's been submitted to Quantopian is and what it takes into account? Is it just
so yeah, at Quantopian we actually I'll repeat the question so I keep forgetting. The question was about what the most successful algorithm at Quantopian was, or has been. So we actually like don't allow ourselves to look at the code. So that's part of our terms on the website. It's part of our agreement with authors. So we don't actually know we don't know for sure what these algorithms are doing because it's still the author's intellectual property. So I can't really answer that question.
just pipes to you just buy this stock at this time or whatever?
Basically, yep. Sure.
You're measuring performance. Is it real performance, like including indicative rates for shorts and the probability of taking a position or handling bid-ask spread and stuff like that?
Yeah. So not in this analysis, but you could include that. Like this does.
When you're talking about Quantopian and, and the performance of the algorithms, that's real trading. That's what I'm wondering.
Oh yeah. We're trading real money right now. So we just started trading real money a few months ago, actually. So it's pretty recent. It's pretty new for us. Yeah.
Are you noticing people front-running your positions?
I can't really talk about that.
Any other questions? Just for my own curiosity. Oh, there's one.
Yeah, I was just
Sure.
curious as to like in a real life algorithm, how many features on an approximation would you consider in a trading strategy?
How many features?
Yeah, how many features? Like rainfall is one feature. Like,
Yeah. So it could be any. It could be one, or it could be 100. You know, really anything that makes money. You know.
You only need one good one, right?
Yeah, exactly. You just need one good one. Yeah.
I have a stock that's paying 9% and one is paying 11%, so that'll meet that. We won't have to go through all kinds of.
Yeah.
His name is Bill. Everybody wants to talk to Bill after this. He's got an inside scoop on something.
Yeah. Yeah.
So you mentioned that a lot of these tools are open source. Are they on GitHub or?
Yes. So the question was where our tools are. Yeah. So they're all on GitHub. It's github.com/Quantopian, or you can just Google like any of these packages, and I'm sure they'll show up. Yep. Mm-hmm.
Do you consider any lag between the cause and the effect? The cause here is the rainfall. Is there any lag?
So yeah, so we're using the 3-month rolling mean. So there's sort of a lag there, and then also it's the pricing data is like 1 day after that. Yeah. Oops. Yep.
Any other questions? Before we wrap up, I just had, for my own selfishness, I'm curious. I hear a lot of great questions. How many people actually trade or do some investing here? Hands up. That's a very good amount.
Yeah.
So with that, we'll close. Let's give Gus another round of applause, and thank you for a great talk.
Yeah, thanks.
So we obviously have time left over. I encourage everybody to stick around for a little bit longer to network, to interact with each other, and feel free to use this space for a little bit longer. Thanks for coming out.